Today we're going to go through the basics of stocks. There's a lot of different types of stocks, but we're just going to focus on a couple because it can get too complicated. We're just going to look at three of the main ones: growth, dividend, and penny. Growth stocks are stocks that you buy because you think they're going to increase in value over time, like Tesla. Other than rising so high that your bank balance goes to the moon, or crashing so low that you crash your car to get that life insurance, there's really not that much to think about, but more on those two later. Next up, dividend stocks. These stocks pay you just for owning them. These payouts come out every quarter, or sometimes every month. That all being said, people mainly buy dividend stocks for their dividends. Sure, it's still great if the stock goes up, but if it goes down, it's not too big of a deal. But if the dividend goes down, you're probably going to want to rethink this stock. Another thing to mention is that you can have combinations of both types of stocks, like growth dividend stocks, where growth stocks do offer dividends. But to keep it simple, we're just going to look at what both types of stocks are known for. Last up, we've got penny stocks, which are basically growth stocks on steroids. True to their name, these stocks are normally worth pennies, and they can go extremely high and extremely low to the point where the company disappears. If you're new to stock trading, you probably shouldn't try this. Or be a one-hit wonder and prove me wrong and become a billionaire overnight. Before you start trading, you should always do research on the stock. Quick question: which one of these are the best places to get advice for what stocks to buy? If you chose any of them, you're wrong. Do your own research. And how do you do research? Look up things like balance sheets, company news, history, and graph patterns, which we won't talk about for this video because it's too complicated. Doing these things gives you a good idea of what the company will do next and where it's headed. But keep in mind that this works less than 50% of the time because the market is never predictable. So don't think that just because you've looked at a company's budget sheet for 3 hours that you're the next Warren Buffett. You aren't. Going back to what I was saying about growth stocks, you're probably going to be finding yourself in situations where you think you're riding an upwards trend, but it actually plummets straight down, right after you buy it. While you can never avoid this, at least you have the research to back up your decisions when you make them. Never buy a stock blindly. Once you have all that information, then you can begin to start trading. When buying and selling stocks, there's two main options to keep in mind: limit and market. For limit, you set the price where you want to buy the stock at. And for market, you buy the stock for the price it's selling on the market right now. Pretty simple. With the market option, you generally buy or sell the stock right away because you're doing it at market value. But with limit, you have to wait until it reaches the limit amount for it to buy or sell. This can take a while. Using this as an example, say you want to buy a stock right away. You do market. But say you think it's going to go down and you want it at a cheaper price, and you want to buy it as soon as it hits that price. You do limit. There's also two general types of trading activities: day trading and long-term trading. Day trading is when you buy and sell stocks every day, or almost every day. And long-term trading is when you buy a stock and hold it over a long period of time. While buying and selling stocks is the more common approach for the normal investor, there is another high-risk way to trade stocks, and that's called options. Putting it very simply, options are when you bet that a stock will either increase, which is called a call, or decrease, which is called a put. And for that, there's two options as well: buying and selling. If you just found out what a stock was a minute ago, never sell. When you buy options, you put in a set amount of money called a premium, and then you have the right to buy or sell a stock during the time frame. That means if your bet doesn't go through, the most you can lose is the money you put in for the premium. But when you sell options, you have to buy or sell the stock at the end of the time frame. So if your bet's way off, you're done. Here's some examples. Let's talk taxes. In a normal account, you have to pay taxes on the money you make from stocks. But you can get a tax-sheltered tax account called a Roth IRA. Buying stocks through this account protects any earnings you make from selling your stocks by taxes. The same apply to dividends. Some employers actually contribute a percentage or even match your contribution to that account. The downside is that you can't withdraw from this account without penalties until you're 59 and a half and have had your account for at least 5 years. There are certain cases where you can get around this, but you usually need to be in some significant financial stress. Keep in mind that day trading is taxable no matter what the account it's in. So if you're day trading, you can just make a normal account and do any long-term trading in a Roth IRA to avoid those taxes. You can trade stocks through big banks or independent companies like Wealthsimple, Questrade, and Robinhood. Okay, maybe be careful with Robinhood. The pros of big banks is of course stability. You'll get customer support for any issues you have, and the security is generally better. But the biggest con of big banks is that they're extremely expensive for each trade you make. For example, a big bank charges $7 for you to buy and sell a stock. So that means you're already down $14 no matter what, because you have to do both options eventually. With smaller companies, the fee is much smaller, but they normally offer little to no customer support and they aren't as secure. So that means if you have any problems on the way, you're on your own. Now that you've got all the basics set up and you're ready to trade, here are a few things to consider. Blindly following trends. It's common for new investors to experience fears of missing out when they see sudden spikes in the market and blindly buy into the trend to get into it as soon as possible, only for it to fall way down after they buy it. As I was saying earlier, make sure you do some research to find out why it's actually going up and then making your decision based on that, not just because it's high right now. Risk tolerance. Only spend what you can afford to lose. For example, if you put your life savings into GameStop at $300 thinking it was going to shoot off to the moon, you'd be broke right now. Developing a strategy. Find a strategy that works for you over time based on what you experience in your own trading. And once you have one, remember that the market is never predictable, so there's always going to be volatility in the market. That doesn't mean you should change your entire strategy, and it definitely doesn't mean you should be making rash decisions to your portfolio just because one thing didn't work out. Diversifying your portfolio. Buying stocks from different industries makes you less likely to be hit by any crashes in a certain industry. For example, if you got stocks in health, tech, and oil crashes, you've still got the other two working for you. The same applies to stocks. You probably shouldn't spend all your money on one stock. Keeping track of your stocks. This should go without saying, but I've seen people buy a stock and just forget about it. If you're a day trader, of course you'd be checking the stock every second, minute, or hour. If you're a long-term trader, every couple weeks or months, up to you. Make sure you check it though. Alright, and that's it for this bare bones video. Thank you so much for watching. If you liked it, please leave a like. If you didn't, please leave a dislike. I'll see you soon.